The basics of financial investments, stocks, bonds, and cryptos. Investing can seem like a daunting topic, especially with the various options available today. Whether you're looking to grow your wealth, secure your future, or diversify your portfolio, understanding the basics of stocks, bonds, and cryptocurrencies is key. In this video, we'll break down these three major investment categories so you can make informed decisions about where to put your money. By the end of this video, you'll have a solid foundation on how these assets work and how to use them to build your financial future. Stick around till the end for some helpful tips on how to get started with each of these investment options. 1. What are stocks? Stocks, also known as equities, represent a share or ownership in a company. When you buy stock in a company, you're purchasing a small piece of that company, making you a partial owner. As the company grows and becomes more profitable, the value of your stock can increase. Conversely, if the company performs poorly, your stock value may decrease. How stocks work. Stocks are traded on stock exchanges, such as the New York Stock Exchange, NYSE, or NASDAQ, where buyers and sellers come together to exchange ownership of company shares. There are two main types of stock. 1. Common stock. This is the most common type. 1. Common stockholders can vote in shareholder meetings and may receive dividends, a portion of the company's profits. 2. Preferred stock. Preferred stockholders receive dividends first and have priority over common stockholders if the company is liquidated, but they typically don't have voting rights. Advantages of investing in stocks. 1. Potential for high returns. Historically, stocks have provided some of the highest returns compared to other asset classes, especially over the long term. 2. Ownership in a company. As a shareholder, you have a stake in the company's performance and growth. 3. Liquidity. Stocks are easily tradable, meaning you can buy or sell them relatively quickly. Disadvantages of investing in stocks. 1. Volatility. Stock prices can fluctuate significantly, sometimes without warning, depending on company performance, economic conditions, or market sentiment. 2. Risk of loss. If the company underperforms or goes bankrupt, you could lose your entire investment. When to invest in stocks. Investing in stocks is best suited for those who are looking for long-term growth and can tolerate short-term market fluctuations. If you're young or have a long time horizon, investing in stocks can be a great way to grow your wealth. 2. What are bonds? Bonds are a type of debt investment where you lend money to an entity, such as a government or corporation, in exchange for periodic interest payments and the return of the principal, the amount you invested, when the bond matures. In simpler terms, when you buy a bond, you're essentially acting as a lender. How bonds work. Bonds have a face value, the amount the bond is worth at maturity, an interest rate, also called the coupon rate, and a maturity date, the date when the bond issuer will repay the principal. The issuer of the bond makes regular interest payments to the bondholder until the bond matures, at which point the full principal is returned. For example, if you purchase a $1,000 bond with a 5% interest rate, you'll receive $50 in interest annually, and at the end of the bond's term, you'll get your $1,000 back. Advantages of investing in bonds. 1. Lower risk. Bonds are generally considered safer than stocks because they provide fixed interest payments and return of principal at maturity. 1. Government bonds, in particular, are considered low risk. 2. Steady income. Bonds provide predictable, regular income through interest payments, making them attractive to conservative investors or those who want a steady stream of cash flow. 3. Diversification. Bonds can help balance the risk of a portfolio that contains stocks, as they often behave differently from stocks in various economic conditions. Disadvantages of investing in bonds. 1. Lower returns. While safer than stocks, bonds usually offer lower returns, especially in a low interest rate environment. 2. Interest rate risk. If interest rates rise, the value of existing bonds falls. 2. This is because new bonds will offer higher interest rates, making your older bonds less attractive. 3. Credit risk. If the issuer of the bond, such as a corporation, defaults, you could lose your investment. When to invest in bonds. Bonds are ideal for those who are looking for a more stable, income-generating investment with lower risk. They are a good choice for conservative investors or those approaching retirement who want to preserve capital and earn regular income. 3. What are cryptocurrencies? Cryptocurrencies are digital or virtual currencies that use cryptography for security. Unlike traditional currencies, cryptocurrencies are decentralized and operate on a technology called blockchain, which is a digital ledger that records transactions across a network of computers. The most famous cryptocurrency is Bitcoin, but there are thousands of others, such as Ethereum, Ripple, and Litecoin. How cryptocurrencies work? Cryptocurrencies are not controlled by any central authority, such as a bank or government, making them immune to government interference or manipulation. Instead, transactions are validated by users on the blockchain network, ensuring transparency and security. When you buy cryptocurrency, you're purchasing a piece of digital code stored on the blockchain. Cryptocurrencies can be bought and sold on exchanges like Coinbase, Binance, and Kraken. Many cryptocurrencies also offer the potential for staking, where you can earn rewards by holding your coins to support the network. Advantages of investing in cryptocurrencies. 1. High return potential. Cryptocurrencies have historically offered some of the highest returns, especially during periods of market bull runs. 2. Decentralization. Cryptos operate outside the control of governments and banks, offering a level of independence and freedom. 3. Innovation and future growth. Cryptocurrencies and blockchain technology have the potential to disrupt industries like finance, supply chain, and more, making them attractive for those who believe in their future. Disadvantages of investing in cryptocurrencies. 1. Extreme volatility. Cryptocurrency prices can swing wildly in short periods, making them risky for short-term investors. 2. Regulatory uncertainty. Cryptocurrencies are still in a regulatory gray area in many countries, and changes in regulation can drastically affect their price and viability. 3. Security risks. While blockchain is secure, cryptocurrencies are vulnerable to hacking and theft, particularly if you don't store them properly in secure wallets. When to invest in cryptocurrencies? Cryptocurrencies are best suited for those who are comfortable with high risk and have a long-term view. Given their volatility, they should be approached with caution and only form a small part of a well-diversified portfolio. 4. Comparing stocks, bonds, and cryptocurrencies. Now that we've broken down the basics of each investment type, let's quickly compare them. 1. Risk. Stocks tend to be the riskiest of the three, but also offer the greatest potential for growth. 1. Bonds are lower risk but provide more modest returns. 1. Cryptocurrencies carry a high level of risk, particularly due to their volatility, but can also provide extraordinary returns. 2. Returns. Historically, stocks have offered high returns over the long term, followed by bonds, which tend to provide more stable but lower returns. 2. Cryptocurrencies have been very volatile, but during periods of market growth, they can offer substantial gains. 3. Liquidity. Stocks and cryptocurrencies are both highly liquid, meaning you can buy or sell them easily. 3. Bonds, on the other hand, can take longer to sell, depending on the market and the specific bond. 4. Income. Bonds and stocks, through dividends, can provide regular income, while cryptocurrencies generally do not. 4. However, some cryptocurrencies allow you to earn rewards through staking, which can offer passive income. Conclusion. Which investment is right for you? There's no one-size-fits-all answer when it comes to investing in stocks, bonds, and cryptocurrencies. Each type of investment offers its own set of advantages and risks, and the right choice depends on your financial goals, risk tolerance, and investment timeline. 1. If you're looking for long-term growth and can tolerate some ups and downs, stocks are a solid choice. 2. If you prefer lower risk, stable income, bonds might be the way to go. 3. If you're open to high risk and potential high rewards, or you believe in the future of blockchain technology, cryptocurrencies may offer exciting opportunities. The key is to diversify your investments, spreading your money across multiple assets to balance risk and reward. As always, before making any investment decisions, make sure to do your research and consider consulting with a financial advisor. If you found this video helpful, don't forget to like, share it with your friends, and subscribe to our channel for more financial insights and tips.